when it comes to the actual setting up the trail stop, this is what we want to quickly cover here. So when you go into both, if it's a call or if it's a put, you can look on a grid and you can select the actual contract given that stock, and then you can hit the review button at the top, and so you can choose how many contracts you want to buy, the limit that you want to take, and then you can be able to select basically how you want to structure and organize that type of play. So after you change, again, strikes to 50, so you can kind of get a list of it, and you reviewed your order. Let me see here, make sure this is actually making sense. All right,
you go first review after you. So at 7, you're going to choose if you're going to pick a where it says 7, you're going to choose if you're going to choose a limit order or a market order, and then right under there you're going to choose how many stock options you would like to purchase, and there you go. But from there, then you go to review.
Gotcha. Yeah. Yep. All right. So make sure this is here. Yep. So once you hit review, then you want to set up the trail stop here based off of the conditions on that particular order. And when you view it here, when you're looking at the limit at the top, you want to make sure it's in that unlocked position, right? And then you want to be able to change TIF to G to C, right? And then you want to select the conditions for it. And so when you're at number 4 and you're actually structuring it in a way that you can prevent the downside here based off of like your risk, you want to go to the actual submit on market condition. So make sure that's clicked on. And then when you hit the trigger on your account, you want to that's where you want to have it set to trail stop. And so that means given this threshold, right? And you want to make sure this threshold is a negative number. So if it moves in a direction that is creating loss on this particular option, it will trigger in an event in which it would create that type of transaction to be able to remove you from additional exposure on this type of option here. So again, you want to always make sure you select a negative number when you're setting up a trail stop here. And that negative number, it could be -1, -2. It depends on like your risk tolerance again. So it's all about how much risk you're willing to take. So that means if it's losing money and it's starting you losing less than 25 cents or $1 or $2, this is where it's going to trigger that event to reduce your exposure from that stock.
Also, you can change that where it says where your threshold and stuff. You can decide if you want to do it as a dollar amount or if you want to do a percentage. When you click on it, you'll see for dollar, percentage, as well as tick. Tick is more so for people that do futures. So you usually, if you're doing stock options and or just stocks, you'll be doing dollar offset or percentage offset, and you can choose it from there. So you don't have to do dollar or you don't have to do percentage. It's kind of depending on what you want to do. If you're going to do percentage, stay kind of between 10 to 15%, unless you have more of a risk tolerance, then you can do more.
Yep. So that's a good point there. So again, it's all about how you're managing the risk of your exposure given this type of play and this form of asset class.
And then also
it's all about your tolerance, or whatever your risk tolerance is. You want to make sure the threshold reflects that, and that way you can be able to get into a position, but then be able to trigger an event to be able to get you out of the position, given that risk threshold.
Okay, yeah, and also good GTC. That's more so good to, that means good to close. So you're kind of holding that. Like if you're gonna hold it, you want to use GTC. If not, if it's just more so a day trade, and you don't have to change it to GTC. But if you're going to hold it, let's say you got in today and you're going to hold it tomorrow, and if it's still running, you're going to hold it the next day, then you'll put GTC. But if you're going to get in and get out within the same day, you don't have to press GTC. So you just have to kind of really know why you're getting in that trade, what's your whole plan, and then you can decide how you're going to program everything.
Yep. And that also goes into like the trading strategy that you want to use. So we'll jump into that later on in the course. So you can actually, tell based off of the position you want to take on how active you are in it. For day traders, again, like, they probably wouldn't they probably wouldn't, hold it for a longer period of time. They're more so doing like, daily type of like activity on a particular option, because again, you can see stock options more so as a portfolio that is income producing, right? So you can really make money if you're day trading in stock options, and you can really create a portfolio of the stocks that you're looking to play based off of like that particular strategy. So that's something to just be mindful of, that when you're getting into stock options, you could, hold it for a long run, but you can also, day trade it. You have that option. All right, so again, when we're setting up a trail stop, is we're adding a condition to a particular order that we're looking to make and review. So when you're ready, before you submit that order, you want to make sure you add that condition, just given your threshold and what is triggering it. So that's just something just to keep in mind, because this could be a little nuanced when you're in the app and you're getting it set up, that you're adding the right condition, and like you're selecting that negative number, because that will inform the activity on how to move forward given this particular event. All right. So let's keep going there. All right. So I did want to also quickly touch on like the 5 main Greeks of stock options. This is just a way to just kind of get you familiar of like some of the language that you might see when it comes to looking at different positions, given like the relative sensitivity of a particular option, right? Given the underlying volatility or security of that option. So we have delta, theta, gamma, vega, rho. This is just a way to kind of look at the risk, given the changes and that particular option's value. So when we look at a stock option, you can almost look at it as almost like an insurance. So when you put in a put option, it's like you're buying insurance for the potential downside risk of it going down. And when you're getting that insurance, like you're setting yourself up in a way that if the underlying value of those assets decrease, you're able to really prevent yourself from incurring a lot of loss associated with that by playing a particular position there. So you can actually understand the sensitivity of that option's price by knowing what that value is, and that's where the delta comes in. And then when you look at theta, right? So we understand the Greeks of when it comes to stock options. This is the rate of time decay of an option. So so when you're looking at the time expiration and in terms of the maturity of a particular option, this is where like that theta value comes in. And then you have the other Greeks, just so you can kind of get familiar of like some of these terms that you may see when you're looking at options, and that you can kind of manage the risk with a particular stock.